So the one that we're looking at right now is actually a draft version issued by the IRS for 2019, although it looks quite similar to the 2018 form. I don't expect that there will be a lot of changes from this draft version. So you'll notice that the first thing on this form is actually your filing status. This affects many things on your return, including the amount of standard deduction you'll be able to take, so it's important that you get this right. So single is kind of like the default. This is the filing status that you'll be picking if you don't fall into any of the other 4 categories. Pretty straightforward. If you're unmarried and have no dependent children, you'll probably fall into this category. It's usually advantageous for you to be able to pick any other status besides this one, but not necessarily. Okay, so next is married filing jointly and married filing separately. As the name implies, this means that you are married to someone else, and instead of filing 2 returns, your spouse and you will be sharing 1 single return for married filing jointly. And for married filing separately, as the name implies, it means that you're married, but you'll each be filing separate returns. You'll notice that there's lines for the taxpayer. In this case, we'll say that this is you, as well as a line for information about your spouse and your respective social security numbers. So there are pros and cons to filing jointly, as well as to filing separately. It's difficult to choose one over the other without knowing the exact facts and circumstances of the individual case, but married filing jointly is almost always going to produce greater tax savings for you. Just know that if you elect to file separately and one spouse itemizes, the other spouse must also itemize their deductions, even if these deductions sum to less than the married filing separately standard deduction. You'll probably want to take the time to calculate your tax due under both the joint and separate filing systems to determine which one is better for you in the given year. You are considered to be married for the entire tax year if on December 31st you were legally married and living together as husband and wife, you were living together as husband and wife in a state-recognized common law marriage, you were legally married but living apart and have not made any action to legalize your separation, or if you were legally separated under a decree of divorce, but the divorce has not yet been finalized. You can still file a joint return if your spouse died at any point during the current tax year, as you will still be considered married for the whole year. Now, for 2 years following the year of your spouse's death, you may qualify for the last filing status over here, qualifying widow or widower, if you also support a dependent child and have not remarried during that time. The child must be your dependent biological child, adopted child, or stepchild, not a foster child, and they must have lived in your home all year except for temporary absences, death, or kidnapping. You also must have paid more than half the total cost of keeping the home in which you and the child live, including food expenses, rent or mortgage interest, home insurance, real estate taxes, utilities, repairs, and more. With this filing status, you will get the same tax benefits that you would receive if you were married filing jointly. This means that you're entitled to the most advantageous tax rates and the highest standard deduction amount. Now, the last filing status on here is head of household. This status is for single or unmarried taxpayers who pay more than half the cost to keep a home and have a qualifying person living with you in that home for more than half the year except for temporary absences. There is one exception in which a dependent parent is not required to live with you, and you may claim the status if you have a dependent parent who lives on their own or in an assisted living community. It entitles you to a lower tax rate and a higher standard deduction than a single filer, but less than married filing jointly. A qualifying person is your child, stepchild, or foster child, and they must have lived with you in your home for more than half the year, same as with the qualifying widow or widower status. You must be able to claim the child as a dependent. However, there is an exception for this if you cannot claim the child as a dependent because the non-custodial parent is actually claiming them using the rules for children of divorced or separated parents. The IRS offers a free interactive tax assistant online that can help you determine what your filing status is. I will leave a link to it in the description below. So next up is just the full address of you and your spouse, including the foreign country and foreign province, state, or county if that is applicable to you. On the right over here, you can elect to donate $3 to the presidential election campaign. This is completely up to you. Only check the box if you do want to give money to the campaign. And note that if you check for you and your spouse, that will be $3 each. According to the IRS, this fund reduces candidates' dependence on large contribution from individuals and groups and helps place candidates on equal financial footing in the general election. It also apparently helps pay for pediatric medical research. I will say that most of the returns that I see leave this box unchecked, so don't feel like you're pressured to check it if you don't want to. Next is the standard deduction box. Here you will check if you are a dependent of someone else or if your spouse is a dependent of someone else. Note that you, as the taxpayer up here, cannot claim your spouse as your dependent. So this is only if your spouse is the dependent of someone else. For example, if they are an adult but are disabled and dependent on their parents, or if your spouse is maybe elderly and dependent on their children. Underneath that is a box that you can check if you are married filing separately and your spouse itemizes on a separate return, or if you're a dual status alien, which I'm going to just skip over for right now. And then under that are boxes you can check if you or your spouse are over 65 years old. For 2019, this means that you were born on or after January 2nd, 1955. What this does is it entitles you to extra standard deductions. I believe as of 2019, it is $1,300 for each box checked. So if you and your spouse both are over 65 and are both blind, that would be the $1,300 times 4 for a total extra standard deduction amount of $5,200. And this is in addition to your normal standard deduction, which I'll go over later, but you can see the amounts over here. Now, in the next section, you can enter the information for up to 4 dependents. This includes their first and last name, their social security number, their relationship to you, such as a son, daughter, niece, nephew, or parent, for example. And then over here, you can check these boxes for the child tax credit or the credit for other dependents. Note that dependents can be either a qualifying child or a qualifying relative. Note that a qualifying child must be your child, stepchild, or a foster child placed by an authorized placement agency. They also can be a descendant of any of these, such as a grandchild. A qualifying child also could be your sibling, half-sibling, step-sibling, or a descendant of any of them, such as a niece or nephew. The qualifying child must be under 19 years old at the end of the tax year and must be younger than the taxpayer or the taxpayer's spouse. The qualifying child can also be under 24 years old at the end of the year, as long as they are a full-time student enrolled at least full-time during some part of at least 5 months during the year. The qualifying child can be any age if they are permanently and totally disabled at any time during the year. The qualifying child must have lived with the taxpayer for more than half the year, unless temporarily absent due to illness, education, such as the child is away at college, business, incarceration, or they were away for military service. The qualifying child cannot have provided more than half of his or her own support during the tax year, and only one taxpayer can claim the dependent at a time. The other type of dependent is a qualifying relative, which has other types of criteria to determine if you can claim them as a dependent or not. The qualifying relative must either live as a member of the taxpayer's household all year, be related to the taxpayer as a parent, grandparent, step-parent, nephew, niece, uncle, aunt, or in-law, and any unrelated person who lives with the taxpayer for the entire year can also meet this criteria as long as they actually do live there for the entire year and are not a household employee like a housekeeper who lives on site. Similarly to the qualifying child criteria, all year means that except for temporary absences due to illness, education, military service, or being placed in a nursing home for part of the year. The qualifying relative must have income that falls beneath a certain threshold. This includes both earned income, such as working for a wage, and unearned income, such as investment income. This amount actually does change every year, so I'm not going to bother including what the threshold is for now. Just know that according to the IRS's example in the instructions for the Form 1040, a relative with income of $10,000 is too high to qualify. Finally, the taxpayer must provide at least 50% of the total support for the qualifying relative. If you're curious about any of these rules, more information can be found on the irs.gov website, and similarly to the filing status, the IRS does have the interactive tax assistant, which can help you determine who qualifies as a dependent, and I will include the link to that in the description below. Next to each of these dependents, you can check if the dependent qualifies for the child tax credit or the credit for other dependents. The child tax credit is a credit of up to $2,000 per child under age 17. And families may receive up to $1,400 per child as a refund if the credit exceeds the taxes owed. All this means is that if you owe $600 in tax before credits, you can apply this $2,000 child tax credit, and the remaining $1,400 will be issued to you as a refund versus just your tax getting reduced to zero, and that's the end of the story. The credit for other dependents is for children ages 17 and 18 and full-time students aged 19 to 24. The family can receive a non-refundable credit of up to $500 each. So this means even if your tax is only $200, this credit can lower your tax to $0 so you don't owe anything, but you also won't get any refunds for the remaining $300 of the credit.